PACE, or PACE SPAC, is merging with Nerdy. The deal is expected to close in the second quarter of 2021. Now, what is Nerdy? Nerdy is a direct-to-consumer platform called Varsity Tutors, connecting educators with students. Think of it as an online gig economy for students and tutors. Their digital platform is growing very quickly, and in the fourth quarter of 2020, their online revenue accelerated to 87% growth year over year. They operate in a huge space, as global learning outside the classroom is expected to be over $1 trillion opportunity, but it's also a very fragmented industry with thousands, if not millions, of potential educators. It's unclear to me that Nerdy will be the winner. You know, people often think of winner take most economics with big platforms or big markets, but maybe they're tapping into a market that's still big enough that even if it's not a winner take most, but a player that consolidates a portion of the market, could they still deliver satisfactory returns just being a fast-growing contender in a large market? What about valuation? Relative to most of the stocks I cover, honestly, I think Nerdy actually seems to have a reasonable risk-reward. Is it enough to justify getting involved? I'll leave that to the end of this video for you to cover and for me to share the detailed dive. So stay tuned. This video goes out to Edward, Harold, and Stephen, along with all my Unrivaled Investing Journey subscribers. About that, a quick 10-second plug, if you will. My name is Daniel. You're watching Unrivaled Investing. This is a no-hype, mission-focused channel to try to find you exceptional companies and unrivaled investments. If you like learning about potential multi-baggers, the types of companies that can go up hundreds or thousands of percent, make sure you subscribe. If you're already a subscriber, that thumbs up is greatly appreciated. And if you want to follow my personal journey as I look for these potential multi-baggers, go to unrivaledinvesting.com, click on Journey. Now, let's dig into the deal with PACE, or PACE SPAC, merging with Nerdy. So what's the deal? So you have TPG PACE, or PACE SPAC, PACE SPAC, merging with Nerdy. If the deal goes through, the ticker symbol will convert to NRDY. You have a lot of cash coming in, over $700 million in cash coming in, 450 from the SPAC itself, and then a forward purchase agreement and PIPE of $300 million consolidated. A large amount is going to existing Nerdy shareholders, effectively looking to get a payday. The rest goes to the balance sheet, paying off some existing debt and bankers' fees. So the vast majority is Nerdy shareholders, existing investors, and the rest goes to the balance sheet and fees and paying off debt. So that's sort of the structure of what's going on. But what actually is Nerdy? And here I feel like it's appropriate for me to put on the old thinking cap. So I got this message from a sub. He said, "Hey Daniel, think PACE is right up your alley. Would be curious to hear what you think. Merging with Nerdy, not because you're nerdy, but is an interesting model." Thanks, Harold. Thanks. So what is Nerdy? So Nerdy, through their Varsity Tutors brand, is a direct-to-consumer platform for online learning, and it's primarily at this stage. And I'd recommend you view this company and opportunity through the lens of an evolving platform. This isn't something that's going to stagnate, I believe. This is something that's going to evolve and develop over time. And this is where they are today. In the future, as we'll discuss, they are going to be a different company. And I think they'll have incremental value add. So today, the way to think about it is you have tutoring and educational, aspects where it's one-on-one personal instruction or small group classes. Those are sort of the paid and one-on-one experiences that people are looking for, where you sort of have to pay. And then there's these other aspects where it's adaptive self-study, where you have assessments and practice problems, thousands and thousands of problems, so you can sort of size up, do I know material well? Am I where I should be for this subject matter? And then large group classes where it's 500 to 50,000 participants. That just blows my mind. Like some of my college classes I thought were big with like 1,000, 2,000 students, 50,000 participants in a class. I mean, it just shows you the scale of the internet. And for example, here's the after school clubs for K through 8, introducing Space Club with Leland Melvin, and he is an astronaut. He's now retired, but he was on the International Space Station. I believe it was Space Shuttle Atlantis. And like, think how cool that is to actually have an astronaut be one of the teachers, be the teacher for your space club. And admittedly, it's a class for, you know, thousands of students, however many. But that strikes me as super exciting, especially because it's like free to enroll. And the way, and I think this is important to reflect on, is that they're using these clever, you know, big names like, hey, learn space from a real astronaut, you know, for K through 8 kids. You know, I think of all these, you know, tiger moms going, oh my gosh, this is amazing. This is exactly what I want for my kids. You know, so I think, you know, I look at that, and the way to think about this, in my opinion, is that they're using these large group classes and this self-study to sort of, this is a top of funnel to drive the business to the one-on-one and the small group classes where it's going to be a paid product. And so we'll get into that in a second, but it's, can you create enough interest with this for students to say, you know what, I'd want to pay for that smaller group class, whether or not it's very specialized, or hey, maybe it's some experiments on space, or maybe, hey, because it's an adaptive self-study program, I don't know enough about the subject, or it's now become aware to me that I can't actually answer these test problems, these hypothetical test questions, the subject matter really well. Maybe I really need one-on-one tutoring, or I need to get this group classes. So it's either appeal to fear of like, hey, I don't know what I'm doing, or appeal to entertainment of like, wow, this class was great. You know, I learned a lot. Why not do a more in-depth one that's a smaller group class? And the reality is this is already turning into a major platform. In 2020, they conducted 4.7 million hours of live instruction across 3,000 different subjects. So this is turning into a real educational platform, educating tens of thousands of students. So who are the students? And you can see how it's sort of diversified with K through 8, 25%, high school, 32%. So this alone shows you that it's mostly children. You know, you're looking at 50% plus of their business model. That's K through 8 high school kids that are looking to figure out where are they going in the next steps, and how do they make sure they're where they should be in their grade. Then the rest is college. You know, hey, I want to make sure I actually get good grades in college. And or you have a professional credential, you know, some sort of exam, some sort of badge. Hey, I'm smart, let's get this badge. And it signals to the world that, you know, I can do XYZ job, whether or not it's accounting or architecture or who knows what. And so taxes, and so law, and so that's this professional element. And so you could see, you know, the key segments, you know, what's actually driving this behavior across these students is, one is a proactive investment in terms of the students saying, hey, you know, I want to be ahead of the class, or I want to make sure I know what I'm supposed to know before I even get it. The other aspect is reactive or remediation, where effectively, hey, I'm falling behind, the grades aren't where they should be, I don't want to get kicked out of this really expensive school that my parents are paying for. Let me pay a little bit more and get that one-on-one tutoring, so that way I actually get the good grades, or I meet scholarship, and, you know, I can play on the football team, who knows what it is. And then next is, you know, enrichment and passion. So this is, think of the after day, you know, after school projects, or, you know, the parents that are super involved and say, hey, I want my kids not only to get good grades in math and writing, but you know what, they also need to learn about, you know, astrology, or what have you. You know, so let's learn about space. And so, you know, the enrichment and passion, let's build some robots, let's do coding. So that's that sort of thing, where, you know, you can see it's a fairly wide audience, because it's not just focused on kids. That's half their business, but the other half is this older demographic, college, graduate students, and professionals. Who are the, you know, so that's one aspect of the platform. The other aspect is who's actually delivering, you know, who's actually providing the educational materials, in which case you see it's a whole range, whether or not it's teachers, working professionals, grad students, retirees, or self-employed folks. And, you know, 45% hold a graduate degree or more. I think the main sense that you get, it's very similar to the gig economy appeal. You work the hours that you want. They don't have to be particularly strenuous. And it's nice to get a nice supplemental income also from the flexibility and convenience of your own home, because this is all online at this point. So for a lot of people, like, hey, I'm retired, but you know what? Interest rates are low. I'm not getting that income I thought I'd be getting. maybe I'll put in a couple hours and teach some kids math. I'm a retired math teacher, let's say, and this is a great way to do it. And hey, it helps me connect with people. So you could see how the gig economy aspect of this could work with Nerdy, and you can see how it's under 5 hours is the average number of hours worked per week with Nerdy. And going back to Leland Melvin, I think, I doubt that he's spending dozens of hours each week teaching this space camp, class. I think it's like 1 hour a week. And so that's the appeal, is you can get these sort of celebrities that'll, teach a subject, and it gets, holy smokes, a real astronaut teaching you about space, and that draws the interest, and then maybe you sort of upsell to these other products like these one-on-one tutoring or very specific classes. Now, what's the opportunity? And so here it is. They're framing it as, look, there's academic tutoring, which is a $14 billion market. Test prep, whether or not I hear that the SATs are now falling out of fashion, but historically it was things like that, or maybe ACT, or getting some legal GMAT, whatever. Test prep of a nearly $30 billion industry. Professional certifications, training and skills, $14 billion in other education. Hey, I just want to learn about that subject. So you can see, put all these together, and it's $60 billion plus opportunity. So clearly, this is US alone. This is not even addressing international. Clearly, they're tapping into a huge, enormous opportunity that could be, 10x plus upside relative to where they are today. I mean, this is like $100 million revenue today. So this is, hundreds of percent upside, you could think, or thousands of percent upside, if they're able to actually meaningfully capture this and get the mind share of, let's say, most US students and parents and those who are looking to pay. The challenge with this, though, with looking at this, $62 billion opportunity, is that it's really fragmented. And this is the words from management. This is a highly fragmented market today. In tutoring in the US alone, there are thousands of independent companies, so thousands of competitors, effectively, and hundreds of thousands, if not millions, of independent professionals. There is no clear market leader in any of these segments. So that's always a little bit of a red flag for me. Like, I want to find a company with a developing market leader. Maybe they only have 3% market share, and they're doing it through organic growth, and that's, and they think they could grow to 15% market share. That would be like, oh, okay, I'm looking to ride that wave. But when you're sort of saying, yeah, there's thousands of other competitors, and we're one of them, and we don't really know how much market share we have, and it's teeny tiny relative, market share we have is teeny tiny relative to this opportunity. This is making it hard for me to think you're unrivaled, and that's the lens that I want to look at all prospective investments, because if you're unrivaled, it gives you the right to win. Unrivaled means, hey, you offer something, a good or service, that you simply can't get elsewhere, and that gives you the right to take market share year after year after year, where you're growing much faster than your competitors. And you'll see that. You'll see, hey, you're growing 150% while your competitors are growing closer to a market rate. And so that's the variable that I'd want to see. And we'll get into that a little bit later in this video of like, well, what's their growth rate relative to their competitors? And does that suggest they're taking a lot of share? So, you look at their competitors and who they're sort of competing with, and the challenge is that, Chegg is their main competitor, I'd say. It is slightly different business model because a lot of their revenue come from selling actually the materials, but there's a lot of offline solutions in here. Let me shrink my mug a little bit so you can see this a little better. You have strictly online classes, but then you also have these offline approaches for K through 12, but nothing that's really as big a platform as what Nerdy's doing. And you can see, well, Chegg doesn't have that personalized live instruction. It doesn't have multiple live learning formats. So, it's not exactly apples to apples. But they do call out as Chegg as being one of their main competitors. But it is sort of worth calling out that, look, Chegg grew 64% in the fourth quarter to 176 million in revenue versus 87% growth for Nerdy and 33 million in revenue. So, Chegg is already multiples the size of Nerdy, and they're growing, 64% versus 87%. It is slower, but it's still, they're definitely growing, I would argue, faster than the market, or at least at the market. I mean, like, in my mind, there's no way the market's going to consistently grow at this clip. So then the question is Nerdy going to accelerate this 87% growth in the years ahead to really set themselves apart and take share? Or is it possible Nerdy and Chegg both grow and they start to dominate the market over time, and all these sort of other players sort of fall to the wayside, particularly these offline primarily players? So that's sort of the tough focus to think about. But I see this, and I'm thinking this does not reflect that you're unrivaled. This reflects that there's already a lot of players in the arena, and I suspect these folks that are just going to have to adapt to having, especially due to COVID, and we'll have to develop a sort of a hybrid model. So it's just something to reflect on. So what is the model, and we'll get into the exact business model in a second, but I would argue the $10 billion question for Nerdy is, can they build this flywheel that results in self-sustaining growth in the years ahead? And what do I mean by that? You get these flywheels in a lot of businesses where you get more customers. The more customers you get, the more of this key component. Think of it like with Uber. The more consumers going on to Uber, the more drivers you get, the more drivers, the more, rides, and it just sort of feeds on each other until no one else can really enter the marketplace. And so that's sort of what they're aiming for, is like, hey, can we get more and more learners, create more and more expert content, get really high reviews for the instructor ratings, result in more quality experts because more and more learners come on. The learners, they're paying in some cases for like tutoring, where they pay in like prepayment in blocks of time, or they pay for these classes, or they pay for like a subscription to like unlimited number of classes. And overall, it's a very good rating, 68 NPS or Net Promoter Score, saying, hey, by and large, most of these folks would refer other students to Nerdy, or other learners to Nerdy as a platform. And as you get more quality experts, you get more subjects attracts more learners, and it becomes sort of self-sustaining, that drives this growth. So then the question is like, is this going to happen? And are you seeing data that actually gets to that? And I would argue it's a little too early to say like, hey, this for sure is going to work. It's early days is what I'd argue. Now they also spin it from the angle of like, look, not only do you have this cool platform effect, this flywheel effect, but now let's throw in that magic keyword, the secret sauce that all companies nowadays seem to be touting, of AI, of saying, hey, is there an opportunity to use this sort of filtering or matching function to analyze the student and pair them with the right teacher? So here, this student, his parents is putting him up to this, and he doesn't actually want to do it. He's an introvert, and he has low motivation. Whereas, I don't know who this chick is, but she's an extrovert. She's got great grades. She's highly motivated. She's got that pressure. She wants to be that valedictorian, and she's like, man, got to make sure I knock it out of the park. And so she highly motivated. She wants to be given that awesome speech. Doesn't want to get that A-. So, hey, they're gonna pair you to the right tutor, and hey, he's not motivated, so you need to have the person who's gonna be like, lay down the law. And then this guy's like, yeah, I can take you to the next level. I'm ready. I can do the extra detail here, like what have you. So that you could see like how AI could potentially figure out, oh, these students are better matched with these folks based on the experiences we've seen. Well, the low motivated, student, he hasn't done well when he's done with the tutor that only wants to deal with the students that are like super motivated. So, it's funny, like there's an expression like, when the student is ready, the teacher appears. Well, like, maybe that's no longer the case. Like with AI, when the student is ready, well, the teacher is always going to be there. Like whether or not the student's ready, when the student is ready or not, the AI will make the teacher appear. So that's how this is working. And they're saying it results in a better experience, because ultimately, if you're able to better match the education profile, so let's say the educator with the learner, to say, hey, this person has a better flow than that. Hey, maybe you have better chemistry and it works better. So how does this business model work? How do they actually make money? So, as I've already alluded to, they have this free funnel that over 500,000 people use, which is large classes and adaptive self-study. So one is just like, hey, am I interested in the subject? And then two is, am I where I should be? And so these two components feed into small group classes like, hey, let's actually do this subject and learn a lot more, because I'm either not where I should be, or I got an initial interest and I just want to dig a little bit deeper, or one-on-one, where I pay in blocks, prepaid time, usually typically, dollars per hour, 45 to 75 bucks an hour. And you can see the typical order is 9 to 50 hours, whereas small group classes 5 to 20 for 10 to 45 bucks an hour. And so you can see how this sort of model works is you use this, maybe you pay an astronaut, a few $1,000s just for them to guess, to teach a class that only takes them 1 hour a week for 10 weeks. And all of a sudden you can put market the heck out of that in space camp for kids K through 8. And that's a great top of funnel for, tens of thousands of potential students that then sort of feeds into these other aspects. Now, the question is, how much of these two different components actually drive their revenue? And so here it is looking at it, and there's small group classes. So there's small group classes, so a handful of students up to like I think 20 students or maybe 15 versus one-on-one. And they show small group classes growth vectors taking off, where the annualized revenue for small group classes reached $8 million in the second half of 2020, up 185% year over year. What this really means when you're seeing this figure is that tutoring, this one-on-one, is really the vast majority of their business, because they're saying it hit an annualized. So they're taking what the business did in the second half, multiplying it by 2 to get an annualized figure, and saying, hey, that was a total of $8 million versus, $100 million plus in revenue. So the vast majority of the revenue is this tutoring business. And so that's worthwhile to understand. So the vast majority, I would argue, is people currently sort of saying, hey, I probably need to catch up, I need to pass that credential, or I want to proactively invest. But it's this one-on-one tutoring that's driving it. So where are they going, in the future? Let me do a little ghost myself here. So you can see this is how they've developed so far, getting professional, studies like a CPA exam or a financial exam or other different skill development or test prep, SAT, ACT, GMAT. These are all the things I mentioned earlier. And then academic tutoring. These are the different steps that they've been building off of. But now they've started layering in these additional things like small group classes, large format classes, self-study, and they even call out exactly what I was saying, which is large format classes, free live classes with celebrity instructors drive top of funnel growth and engagement. This totally makes sense, which then feeds into the tutoring and small group classes. So this is I'd argue these bottom 6 steps, this is where they are today. But where will they be in the future? And they've started incorporating a subscription element where it's unlimited access to live group classes. But this is where I think they want to be in the future, and where they really start tapping into a huge opportunity of, let's say, moving really full-time homeschool alternative. And that's really come front and center with COVID, as a lot of parents have been sort of struggling with dealing with, hey, how do I make sure my kid doesn't exactly fall behind and still get educated from home? And honestly, the schools weren't adapting well enough to offer a great education. That's not a criticism of the teachers. It's just this was a really hard challenge, but COVID being thrown their way. The next is an international expansion. Hey, can we target additional markets? Hey, we're in US now, but let's start rolling out into the rest of the world. And then targeted M&A, so mergers and acquisitions. Hey, could we, if we're more profitable, can we start rolling out into new markets and acquiring, let's say, other competitors? So, as we look at this, what's their growth actually done? And you can see the total growth, they went from 5% growth to negative 1% in the first quarter, in the second quarter. That's because they've historically had a hybrid model of both offline and online. They've been weaning their offline business, and so that effectively went entirely away in response to COVID. And so now it's entirely online business, and their online business grew 87% year over year. But that's part of the reason why their growth rate, their consolidated growth rate, is much lower at 31% in the fourth quarter, is because they're lapsing a very, effectively a tough comp, because last year, same period, they had offline revenue, whereas here they didn't, and it's purely online. So I'd argue the future of this business is going to be online, so one should focus on that key element. So what do we look at in terms of their projections in the years ahead? And so, as we look at this, they're projecting their paid user growth from 37% growth from 64,000 to 87,000. They're expecting an acceleration to 130,000 in 2021. I'm a little confused by that, in all honesty, and I would love to understand that in greater detail, because arguably you're probably having some sort of bump from COVID in 2020. So why is your growth rate expected to really accelerate from 2020 to 2021 and then accelerate again in 2022? So that strikes me as a little bit tough to digest. That said, their growth rate, given that their online business is growing at, like 87% in the most recent quarter, they are projecting, I would argue, reasonable, expectations for the next 3 years of, let's say, 31, 43, 35%. So you could argue, mid 30s%, revenue growth annualized. And you can see what sort of margins they're projecting. Where in 2020, they're already at 67%. It's not that far of a reach to say, hey, you could be in the low 70s in the near future. With this type of margin, I would expect to be at, maybe 20 to 30%, operating margins in the future, just sort of getting scale on their sales and marketing and all these other costs. And it's also nice to see that their cash burn isn't that excessive, let's say $10 to $15 million a year, relative to, as I mentioned, one of the first slides was effectively saying they're going to have a few $100 million in cash on their balance sheet. So a cash burn that they can easily digest. And by the way, within a couple of years, they're expecting to be profitable and free cash flow generative, so that they don't actually even need to tap into that balance sheet, and they can just self-finance their growth into the years ahead. So that strikes me as, a positive development. And overall, I like seeing these economics. The 70% gross margin. The challenge I have that I think about with this business is ultimately, it's going to be less sticky than a lot of other, let's say, software as a service businesses, because let's say you need tutoring for a subject. Well, you get tutoring for algebra 1 year, and then you master algebra, and then it's like, okay, I'm going to move on to the next thing. And you might not feel like, oh, I need tutoring in pre-calculus, or you're in writing, and you're like, what, I did enough. I'm up to where I should be. So this is a part that management hasn't really called out, which is how sticky is this business? How much of a repeat customer do you get? And that's part of the question about their growth rate in the years ahead, is that, do you have effectively a leaky bottom where you keep bringing in new customers, but effectively they just graduate? They just keep sort of leaking out the bottom where, they had a great time on that tutoring, but they're ready to move on. They passed their test, or they had their test, and they don't need varsity tutors anymore. So that's hard to argue. The challenge with this type of business is that you sort of constantly have to run in place just to stay where you are. But that's the nature of the game, with this business. Not all businesses are like this. Some businesses, and the types of businesses I prefer, it sort of builds on its growth each year. And so you have a large percentage of recurring revenue each year that layers in. And so then any additional growth is the existing customers plus layering on a new cohort. What else? So what is their actual economics target? And this is great that management actually pencils this out in a pretty nice way. This is pretty much exactly what I was saying, which is, hey, your gross margins can develop even better over time. This isn't too far of a reach, if they're already at 67%. And their free cash flow margin, they're saying, is 25 to 30%. I'd want to understand the definition of that, because they're saying it's the same thing as EBITDA, which it's probably impossible to have the same thing because you're going to have taxes. So either way, let's say their operating margins are 25 to 30% over time. And so overall, this is a good data points to consider for our own valuation assessment. They're saying long-term growth rates of 25 to 30%. Quite possible. They are growing well above market, I would think, at their 87% growth rate in the fourth quarter. So what do I think of the valuation? So taking their shares outstanding, and we'll talk about that in a second, multiplied by their share price, that gets to nearly $2 billion valuation. So whatever you see in Yahoo Finance, you got to use the pro forma share count and the actual share price to think about the valuation of Nerdy going forward and what it means for the risk reward. So then you see their revenue, their guided revenue. So their growth rate was actually fairly low in 2020, but that includes their offline business that they lost. And then it's expected to re-accelerate in 2021. But this does, keep in mind, this doesn't address my question of why does your paid users accelerate significantly. Your paid online users accelerate. But overall, I understand why does your total revenue accelerate from 16% to 31%, because it's pure online business, and that your online business is growing quickly. And so you can see 30 to 40%. So this is a little bit better than what management was guiding to for 2021. So I'm doing a hypothetical range. The optimized margins, once again, this was what I initially expected, and this is also what management guided to in their presentation of 25 to 30%. Take a slap on some sort of tax rate of, let's say, 25%, and that gets to a optimized earnings figure of 60 times to 76 times. Now keep in mind, this is part of my value proposition to you, my Unrivaled Investing YouTube subscribers, where you can click on this link in the description of the video, click file, download, and play around with the assumptions yourself to sort of think about where does this go from here. Could it go way higher, way lower? Of course it can, but I like working from a logical framework for how I think about these things. And at the end of the day, a lot of people get confused, you can't value a company using a PE type approach. Well, of course you can. The way you do it is you think about what their optimized margins could be today, and that's what I'm doing today. They're nowhere near 25%. They're cash burn right now. But that way, by taking what is their margin, let's say 10 years from now, what is their long-term margin? What's their long-term structural margin? And what's the difference between their revenue today and then? And that means your return is going to be driven by the growth in revenue. So your main focus should be what's their revenue growth rate in the years ahead. And so that's what I'm doing. So this is a 5-year model because you're looking at 2021, then layer on an additional 4 years. So what do we think this business looks like in a few years? And honestly, I look at it, I'm slapping on a 20 to 35 times multiple. I'm doing growth rates of annualized 25 to 35% a year. Maybe I'm being too conservative here. Maybe it should be even higher as they're in the fourth quarter, their online business grew 87%. Is it possible that they just continue on like machine mode or hyper growth mode and they're able to do much higher than that? Keep in mind, they're not projecting to do faster than that. So if you're a shareholder and you want to believe your returns are going to be much better than this, I'd argue you have to believe, one, that their growth is going to be better than management or what management has projected, or the end multiple assumption is going to be higher. So effectively, investors will be willing to pay more. That's the only way I could justify an even better risk reward or better return upside than what I'm penciling out here. So that's part of the reason why I make these sheets available for you to play with, is you can think about it yourself. You can put on your own thinking cap and say, hey, what do I think the risk reward is from here? So I'm looking at this risk reward, and I think it's all right. I'm not crazy about it. Almost 100% and down almost 40% in this sort of scenario doesn't strike me as crazy compelling. It's all right. It's a lot better than a lot of other SPACs and a lot of other companies I look at. So it's all right. Ultimately, I want to get into this too. So here's the share count, and this is a part that confuses a lot of people. And this is, I think, the best way I've seen the share count laid out from all the videos and all the companies I've looked at, which is that here they show what their share count is based on the share price. And this is the part that confuses a lot of people. So here, this is what you multiply their share price by to figure out what the market cap is in terms of valuing this business. I can take off the thinking cap now. And so first of all, I applaud the bankers, I applaud the management for putting this forward, because this is a great way to frame it. So I'm using 100 million share count, which assumes a $15 price. Currently it's around $11, but if the stock appreciates, you do need to factor in that dilution. Effectively, dilution sort of holds back, the stock from going crazy. So it is worthwhile to understand this element to the share count. But once again, thumbs up for me, for management and bankers, making it easy to understand. There's a lot of presentations that sort of mask these figures. So great job here. So nerdy summary and thoughts. It seems like a high quality platform for helping students get the incremental education they want or need. There's a lot of different needs here, whether or not it's like getting a credential, reacting to where you need to be, or just proactively getting ahead. I definitely get all aspects of that. And it's a big market, 60 billion plus in the US alone, $1 trillion outside global perspective, outside classroom learning. Could they revolutionize school as we know it today? It's from what I can tell, it's too soon to say. Like they're not really tackling that right now. They do mention like homeschool in the future. Could there be an entire online homeschool solution that they bring using all these tools in the future? Possibly. Are they having an impact on the tutoring market as of today? Because keep in mind, tutoring is the vast majority of their business today. Yeah, I would argue they are having an impact. And the challenge is I just don't know how fast that market's growing right now, especially with COVID, bump in 2020. I would suspect they're growing well in excess of the market at 87% in the fourth quarter and, solid double-digit growth in 2020. But it's a tough question to answer. If they are taking share, then it would suggest you do have this winning value proposition, and maybe it continues to go in the future, and that's great. So that is a question mark, but a big question mark also of like, I don't like being set up for a trap. And I feel like a lot of SPACs are doing that, where it's like, yes, we just got this COVID bump. Let's use those financials to base our projections off of, and we don't need to show 2018, 2017, 2016 figures at all. Or 2019. Let's just focus on 2020 that got this bump because we're online, and then let's assume that continues, into the future for infinity. And so you see a lot of that right now with projections. So I just don't want to be in a trap. I want to sort of see how this plays out as sort of society gets back to normalcy, and do they continue to take share? If that's the case, then I think I get more excited about the setup. The valuation, I'd argue, is fully priced for the deal. I'm saying, upside of almost 100%, downside of nearly 40%. So I'm not crazy about the risk reward here. I like the platform. I don't like the fact that there are thousands of different, platforms or competitors out there that are looking to do the same thing, thousands of different educators out there. And at the end of the day, I just think I can find better risk rewards at this point. For example, I had a post on February 17th, just yesterday, as of today, that includes about a dozen companies that I currently own that I think have better risk reward profiles, where it's like, hey, at a minimum, it has, I think, 100% upside in the upside scenario. You can pencil out the risk reward and the upside and downside, but these are things where I just think it's a little more asymmetric in terms of the upside downside risk. But for that, you do need to go to unrivaledinvesting.com, click on Journey, and there's a lot more to it other than just these one-off exclusive posts. Each month I aim to at least identify one potential multi-bagger. I do have an educational series, how to think about valuing stocks, how to think about finding potential multi-baggers, how to think about margins, how to think about hedging. What if the market starts collapsing? What can you do about that? There's also my personal portfolio for those that are interested in following my own personal investment journey. So the full catalog of contents is in a link below in the description of this video, so you can see that in terms of like, hey, these are all the exclusive posts. So if you're interested, you can click on them or see what all the content is before you get involved. And also there's oftentimes exclusive posts that are sort of follow-up analysis to the stock. In this case, I'm not doing an exclusive follow-up on Nerdy because I think I've covered everything, but occasionally there's an exclusive follow-up like, hey, there's a lot more, let's dig into it. And at the end of the day, just finding one potential multi-bagger can change your life journey. So if you're interested in following my journey to try to find these potential multi-baggers, go to unrivaledinvesting.com. And if you enjoyed this video learning about Nerdy or PACE SPAC, right now it'll be NRDY stock. In the future, if the deal goes ahead, please make a point of subscribing. If you're already a subscriber, I appreciate that thumbs up, and thank you so much for watching.